We want to look at banking, financial sector, and economic growth. Therefore, at the end of this topic, a student should be able to understand circular flow of income, should be able to define money, its features, functions, and types, explain the implication of fiscal and monetary policies, and relate growth to unemployment and inflation. National income is regarded as the most comprehensive measure of the level of economic activity and index of economic growth. It is a flow concept in the sense that it is measured over a particular period of time, and conventionally it is expressed over 1 year. Therefore, it can be defined as the value of all goods and services produced by the normal residents of a country in a year. Either they are within that domestic territory of the country or they are outside. There are three measures of national income. GDP, which is the gross domestic product, which means the value of output produced domestically over a period of time, usually a year. GNP is gross national product, which has to do with the value of output produced domestically and the value of output produced from external resources, all owned by the economy. Therefore, GNP can be calculated as GDP plus net income from abroad. So net property income from abroad can mean different inflows and outflows of income in the form of profits and remittances. So in other words, there are some businesses that have subsidiaries outside of a country. So all capital flights, all income, all remittances that gets back into the economy are calculated to make GNP. NNP is the net national product, which is GNP, out of which replacement investment has been deducted. Therefore, NNP equals to GNP minus replacement investment. So why is national income accounted? One, it is important when it comes to government planning because government depends on it. When it comes to taxation plan, growth rate, sector growth, industry establishment, and performances, they depend on national income. Therefore, it is very important that living standard of members of the society must be taken cognizance of. And this cannot be effectively done if national income is not accounted for in an economy. Now, there are three phases of circular flow of income. We have the production phase, we have the income phase, and we have the expenditure phase. And these phases are divided into production sector, household sector, government sector, and the rest of the world sector. Now, in all the sectors and phases and flow, the resources we use in production are land, labor, capital, and entrepreneur, and that must be taken with importance. Because every business that has land as a factor of production employs labor, buys machinery and machines. So circular flow model can be divided into what we call a two-sector economy, which is referred to as a closed economy, a three-sector economy, or a four-sector economy, which is referred to as an open economy. Now let's start with a two-sector economy. It is a model that consists of two sectors, of which are household and firms. Now, households can be individuals or public, and can refer to household as individuals or public, and firms can be referred to as businesses or even productive sector. In the two-sector model, there is no financial sector, there is no government, there is no foreign sector. And it assumes that through expenditure, households spend all their income on goods and services or on consumption. And at the same time, through the expenditure, they purchase all output produced by the firm. That is indeed a circle that is flowing. That means that all household expenditure becomes income for the firm. That means when I'm paid my salary, I go purchase goods in the grocery store. The grocery store takes my cash, give me my resources, my produce for me to consume, for my groceries. Then what the cash I give them becomes their own income as a firm. Now the firm spends all of this income on factors of production. They transfer all their income to the factor owners, which are the household. And the factor owners in turn spend all the income on goods. And this leads to what we call a circular flow of income. From the two-sector model, we will see that the resources, such as land, capital, entrepreneur, they flow from household to businesses. And then we'll see that in the opposite direction, money flows from businesses to the household in form of wages, in form of rent, in form of interest and profit. Also, we are going to see that money flows from household to firms as consumption expenditure. And this is made by household on goods and services produced by the firm. And we have the flow of goods and services in the opposite direction, from business firms to household. Therefore, we see that money flows from business firms to the household as factor payment. And then it flows from household back to the firm, which is a circle. And this continues year after year. And this is always not consistent and constant, because an economy can be in depression for time, an economy can be in prosperity for time. It is the situation of that economy that determines the circular flow of income at that particular. Draw the diagram showing the circular flow of income for a 3 and a 4 sectors, and give us a brief explanation of each of the sectors. And that we are going to discuss in our class when next we meet. And this is very important. Also make references to your core text, to your supplementary text, and especially to your handbook. This will give you a very great direction when it comes to your research work. Money. When it comes to medium of exchange in transaction of goods and services, money is anything that is used for such. Now there are different types of money, such as commodity money. Commodity money is known to be the simplest and about most known as the oldest type of money. It is built on the natural resources that act as medium of exchange, store of value, and units of account. A barter system where goods are exchanged for goods is a good example of commodity money. Example of commodity money includes gold, coins, beads, shells, spices, and so on and so forth. Can you cite more examples of commodity money? Fiat money. Fiat money usually gets its value from government order. That means government usually declares it as a legal tender, which requires all people and firms within the country to accept it as a means of payment. By definition, its intrinsic value is lower than its face value. Therefore, the value of fiat money is derived from the relationship between supply and demand, e.g. coins, bills. These are examples of fiat money. Now, what are the features of money? It should be durable. That means it should be able to last a long time. It must be portable, easy to carry around, and convenient to use. It must be easily divisible. It can be broken down into smaller denominations. It must be hard to counterfeit. That means it can't easily be faked or copied. And it must be generally accepted by a population. Also, it must be valuable. That means it must generally hold value over time. Functions of money. Money can be used as medium of exchange, which allows goods and services to be traded. And this does no longer require barter system where we rely on goods for goods. And as a matter of fact, barter system failed because of problem of double coincidence of want among others. Money also can be used to store value. In other words, value can be retrieved at a later date. Unit of account. It refers to anything that allows the value of something to be expressed in an understandable way. And then, money can be used as standard of deferred payment. If people borrow today, they can pay back their loans in the future in a way that is acceptable to the person that has made the loan. Macroeconomic policies are utilized when governments attempt to intervene when it comes to policy objectives and improvement of overall performance of the economy. Therefore, macroeconomic policy is very essential and crucial in every country. Now, what are the objectives of macroeconomic policies? 1. To sustain economic growth. To stabilize price when it comes to inflation or deflation. To ensure high level of employment, thereby reducing unemployment level to a single-digit figure. To increase the living standard of every member of the society. To ensure that the position of the balance of payment is sustained. And to enforce sound government finances. But there are major problems when it comes to managing microeconomy. One is inaccurate economic data. Sometimes there are margin of error. When we rely on statistical data from tax returns and surveys, sometimes that can be a problem. Another challenge of managing macroeconomy is conflicting policy objectives. For example, a policy that can stimulate aggregate demand may reduce unemployment, but sometimes it can bring about inflation at a particular period. Another challenge of managing macroeconomy is selecting the right policy instrument. Every objective requires different policy, and different rule of thumb must be assigned to each policy. And sometimes there is disagreement. And finally, we have uncertain time lags when running a policy. For example, change in interest rates is estimated to take between 18 to 24 months to work its way fully through the whole economy to filter a change in price. So sometimes there is no certain time lag that can be fixed when it comes to economic policy. And this makes it challenging when it comes to managing economies in different countries. Fiscal policy is a good example of the macroeconomic policy. And this is when government spending and taxes are used by the central government to stabilize business cycle, to reduce unemployment and inflation, and promote economic growth. The goal of fiscal policy is to ensure that aggregate expenditure is manipulated, either through government purchases or indirectly through taxes and transfer payment. Fiscal policy tools. Fiscal policy works through the two sides of government fiscal budget, spending and taxes. And one important tool is government purchases. And these are expenditures by the government sector, especially by the federal government, on final goods and services. Another tool is taxes, which are involuntary payments from the household sector to the government sector. They are usually the primary source of revenue used by government to finance government spending. And usually, taxes affect the amount of disposable income available for consumption and saving. Transfer payment. Transfer payments are gifts made to the household sector. They are not made in exchange for goods and services. Because these are financed with taxes, transfer payments are in effect the transfer of income from one person to another. Economies can be managed using expansionary fiscal policy or contractionary fiscal policy. Expansionary fiscal policy can be used to correct problems of a business cycle contraction. And such expansionary fiscal policy helps in reducing unemployment and increasing aggregate expenditure and aggregate demand. And such policy include combination of increase in government purchase, decrease in taxes, increase in transfer payment. Contractionary fiscal policy, it corrects inflationary problems when there is a business cycle expansion. And in such a situation, government decreases purchase, increases taxes, decreases transfer payment. And this contractionary fiscal policy focuses on restraining the economy by decreasing aggregate expenditures and aggregate demand. And the focus or the aim is primarily to reduce inflation. Monetary policy is another macroeconomic policy. This is when monetary authority of a country controls the supply of money, and usually by targeting a rate of interest so that there could be economic growth and stability. To stimulate the economy, money supply is increased, interest rate is reduced. And to dampen the economy, money supply is decreased, interest rates are raised or increased. Different monetary policy tools include open market operations, which is the selling and buying of treasury securities, discount rate, of which if it is adjusted can affect the availability of loans and the creation of money in the economy per time, reserve requirement. This is when the Federal Reserve adjusts the proportion of reserves that bank must keep. And this is used to control the money supply in the economy per time. Expansionary and contractionary policies in monetary policy can be used to control the velocity of circulation of money. Also, it can be used to control the level of interest rate. For example, expansionary monetary policy. This focuses on correcting business cycle contractions. When there is unemployment, expansionary monetary policy addresses such. Whereas contractionary monetary policy corrects excesses in business cycle expansion. For example, when there is problem of inflation, the Federal Reserve can decrease the money supply. They can also increase the interest rate. So these are policies that economies of the world utilize when it comes to macroeconomic policy. How does macroeconomic policy affect business cycle? This is a research work, and I want you to refer to your core text, the supplementary text, and also refer to your handbook for better knowledge and for you to be able to acquire the necessary information for the purpose of this research work.